This year, we're expecting for emerging markets generally an average growth of 6%. But there's some countries like China that will be growing at 8 or 9%, India at 6, 7%. Of course, East European markets will be slow. The impact of the slowdown in Europe will have a big impact on Eastern Europe, but generally speaking, given the projections I've just given you, the slowdown in the U.S. is not going to have a big impact on the growth rate in emerging markets. There's no question they're not as cheap as they were early last year or the end of '08, but we are now more or less in the middle of the range, of the historic range. Just to give you an example, price to book value, the lowest point in the last 15, 20 years has been about 1 times book. The high point was 3 times book. We're now more or less at 2 times book. So we're in the middle. Well, the growth is going to be coming a lot from the domestic markets themselves. In other words, rather than export-oriented growth, you're going to see domestic-oriented growth. Consumer spending is going to be increasing in these markets. So more and more growth rates will be coming from the domestic consumption rather than exports. Of course, in some of these markets with strong commodity exports, commodity prices will play a big role. The big commodity markets, of course, would be Russia and Brazil. Of course, related to Europe, the sovereign risk, in other words, risk of a downturn in sovereign bond ratings, that could have an impact, a knock-on impact on markets generally. The other big risk, of course, is derivatives. Derivatives continue to be a huge part of the total financial system. Over $600 trillion, which is 10 times more than the total GDP of the world. So that is something we have to watch very carefully. And of course, money supply. If money supply heads downwards, if there's a slowdown in the increase in money supply growth, then you could see that impacting markets. Generally speaking, in the total emerging market picture, I would say maybe 80% in normal global emerging markets areas, and about 20% into the frontier area, because we believe that the frontier markets will be growing at a faster pace going forward. It will change, of course, depending on pricing. Frontier markets are now cheaper. If they become more expensive, then the weightings would have to change. Also, we must remember within the emerging market spectrum, there are lots of products like the BRIC funds, like the small cap funds, etc. So I would say now within the 80% global emerging markets, you may want to put a little bit more into Asia growth and Latin America and small cap. Those are the areas that are interesting now. Well, Pakistan and Thailand both are very attractive now because of the pricing, the political turmoil, all the talk about the failed state in Pakistan. That will all contribute to depressing prices and therefore provide opportunities. Simply because of valuations. We find the valuations are very good. We don't think the country is going to come apart. We think there still will be a country, Thailand. We think there still will be a government. There'll be lots of turmoil, but the companies are quite inexpensive now. Well, it drags a slow growth. I mean, the problem with these countries is that, as you mentioned, they were lending, the banks were lending people yen and Swiss francs. And then when their currencies got weak, local currencies got weak because they're not in the Eurozone yet, they were in trouble, the banks were in trouble. In addition to that, the governments have been spending too much, so they've got big deficits. And the solution they find is to raise taxes. Of course, that slows down the economy even further. So it's a vicious circle that they have to get out of. Of course, they have the support and help of the EU because they're all EU members, and that helps. But it's going to take a time. It's not going to be a crisis, but it's just going to take time. There's no question that the Russian government depends on oil income to balance its budget, but minerals generally are very important to Russia, not only oil, but things like nickel, palladium, and so forth, iron ore, coal. They've got all these resources, so they've got lots to fall back on, and lots to export, as well as consume domestically. But the government is moving inexorably towards a wider scope in their economy. In other words, they're trying to develop more consumer products, they're trying to develop more high-tech products, and this, of course, will balance the economy going forward. We've been bullish on Turkey for quite some time, and it paid us off because they've been growing at a good pace. They have a relatively young population. So we look very, very closely at consumer-oriented companies that are supplying to consumers, banks, because a big part of the country is underbanked, so there's lots of opportunities in consumer banking. And there's certain individual companies that are doing very well because they are almost a monopoly. For example, in the refinery area, one of the big refineries has the bulk of the refining capacity in the country, so that's a very good investment. Yeah, there's concern that the current party, which is Islamist, could move more towards an Islamist state. But the pressures towards a secular state are very, very strong. As you know, the father of secularism in Turkey is still very much revered. So we believe that it will be very, very difficult for any government to turn Turkey into an Islamist state and, for example, institute Sharia laws and that sort of thing. I just don't see that happening. Of course, nobody can predict what's going to happen from one minute to the next, but generally speaking, it's hard to believe that there'll be a sharp and sustained upward movement in the Asian market because of the incredible amount of money being raised in IPOs, initial public offerings. Chinese banks, Chinese companies continuously come for more money, and that of course tends to have a depressing effect on the market. Yes, because we have money coming in every day and we have to get it invested. And India is one of the top markets that we see. Although it's gotten more expensive, it's not too expensive, so there's good growth in many of these companies. And we, of course, are looking at commodity companies like Sesagoa, which is a commodity play, iron ore, we think is going to continue to do well. And the spectrum in India is pretty wide because you've got the software companies that are doing well, not only in India, but globally. And you've got some of the large oil companies in India that are interesting. So it's a pretty good selection that we have.